But the real question is, how far does the bubble go? Which brings me back to that point I made earlier that, things can get really, really silly. Everyone thought 1996 was silly, as you said before we started recording, and then it got just ludicrous for 4 more years.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're diving into the volatile world of markets, metals, and the miners. I'm thrilled to introduce Graham Summers, Chief Market Strategist with Phoenix Capital Research. He's a best-selling author and the brilliant mind behind Gains, Pains, and Capital. Graham, it's an honor to have you on Metals and Miners. Welcome to the show.
That's very kind. Thanks for having me.
Graham, you have decades of market experience. You're a chief market strategist. You're a best-selling author in the space. There's lots of conflicting narratives. We were just talking about this off camera here that are out there. Many are believing the worst about the markets is right around the corner. Meanwhile, there are some that are saying, hey, get ready. We're going to embark on this historic meltup, and about every asset's going to be going along for the ride. Right. It's leaving many retail investor heads spinning. What do you hope that those tuning into our conversation today are going to walk away with after listening to this discussion?
Yeah, that's a great question. I think the single most important thing you need to think about is, I like to keep things very simple. The first thing is you want to make money from the markets. That's why we do what we do. If you want to just be smart and have an opinion, that's different. But if you have capital put to use, you want to make money. And the way historically you make money from stocks is you ride bull markets as long as you possibly can, and then you rely on some key indicators that tell you when it's time to get out, because what you want to do is avoid the bulk of a bear market. The way I put this is, you're not trying to call a top, you're not trying to even predict a crash. You're simply saying, okay, if you divide a major run into, say, eighths, you want to catch the middle 6. You don't necessarily need that first eighth. You don't need that last eighth. You just want to make sure you catch the bulk of the move, and you want to make sure that you miss the bulk of the bear market so that you keep as much of the capital you've accrued during the bull market in your portfolio. And so for that reason, it's people who are sort of perma bears, who are always expecting the worst. They're kind of doing you a disservice, because historically stocks tend to go up. There are definitely periods of time in which they go nowhere. We had one from the late 90s until about 2014. If you look at a chart of the S&P 500, it kind of was just in this massive sideways range where no money was really made. We had other ones historically. We've had 2 or 3 of them in the last 100 years. But by and large, for the most part, and especially since we left the gold standard, and especially since we got into this area of serial bubbles, which began in the 90s, where kind of the Federal Reserve figured out that so much of the net worth of Americans' households is based on real estate and stocks, it's gotten to the point where eventually they're going to save stocks. They want stocks to go up. And so if you're someone who's betting on crises, you're betting on the world ending, you're kind of betting against the guys who can literally print money at will, which is really not going to work in your favor. And so I'm as aware as anyone else of the risks and the consequences. It's very clear things are starting to get silly in the financial system, especially with some of the valuations of these AI plays. But that doesn't mean that it's time to suddenly panic and go short. You need to let the market play out, try and ride it as long as you can, and then say once it rolls over and breaks below, a key moving average, like maybe the 200-day moving average or something like that, then you get out of stocks for a while.
Okay, appreciate it. There's a lot there. Let's start with the U.S. dollar. The Dixie's sitting on an important resistance area that's held since the 2008 great financial crisis. I actually just saw a chart, though, going back to 1970. And in general, the dollar is in a downward trend, a long downward trend, but it's been in an upward trend since 2008. It's touching the bottom resistance line. President Trump, he's repeatedly said that he wants a weaker dollar. Since gold and silver are priced in dollars, a declining dollar automatically makes those metals more attractive to international investors. It creates upward pressure on prices. The currency effect combined with the fundamental drivers of supply and demand, it creates a powerful tailwind for the precious metal sector,
Yes.
and that could last for years. What are your thoughts on the US dollar, where it sits, if it's going to go lower, higher, and it's as a potential tailwind for the precious metals?
That's an excellent question. So we have to think in terms of time frames. So the fact that the dollar is at this sort of critical trend line, as you noted, and the fact that so many people are bearish on the dollar, to me as a contrarian, kind of opens the door to maybe a dollar rally, just because in investing, things never go straight up or straight down. We've had this incredible run in precious metals. We've had this incredible collapse in the dollar. The dollar had the worst first half of a year since 1973, which is only a couple years after we came off the gold standard. And so many people are fully aware of how badly the dollar's doing, and so many people expect money printing and yield curve control coming from the Fed that as a contrarian, maybe in the short term, we're going to see a dollar bounce or the dollar bottom. Now, having said that, in the big picture, intermediate term and long term, it's become very clear that policymakers have no real levers to pull other than printing money. And they're doing this at a time when the US and many other developed nations are running deficits that are historically massive. The biggest story to me are two things. One is COVID and the lockdowns opened the door to an amount of spending that was just astronomical. And we never got back to normal after that. If you look at the deficit as a percentage of GDP for Europe, for the United States, for many nations, the deficit has dropped from the COVID lows, meaning the deficit's smaller relative to GDP than it was during the absolute lockdowns and pandemics. But we never went back to the pre-pandemic levels. We never went back to what was normal before COVID. And so what's happening is the governments are just running these massive deficits, which means they're spending more than they take in via taxes, which means they're issuing debt. And central banks are realizing that this fiscal dominance is leading to so much debt being created that there's no way forward for them to do anything but to try and keep the debt under control, which brings me to the second big point, which is the defining quality for the financial system in the last 40 years was the secular bull market in bonds, which was, since 1982 until about 2022, the bond market was in a secular bull market, a multi-decade bull market. That meant that yields were getting lower throughout that time period, which meant it was ever cheaper and cheaper to issue debt. When inflation entered the financial system, that period ended, and we had, during 2022, one of the worst years for financial assets where both bonds and stocks sold off. Very different from other crises. Historically, tech crash, great financial crisis, bonds were a hedge that made money while stocks declined, not in 2022. And if you look at a chart of the US treasuries bonds, especially the longer term ones, the 10-year, the 20, the 30, you've got this yield where it's just coming down. It breaks out of that downtrend, and it's been consolidating since 2022. And for me, the big question we all need to be thinking about is if the economy weakens or if things start to deteriorate in the financial system, are yields going to collapse again, meaning that we're back in a bull market for bonds? Or are we in a completely new regime where, because there's so much deficit spending and central banks are now easing, because we've begun another global coordinated easing cycle for central banks, are yields actually going to break out of that consolidation period upwards, which would indicate we're in a completely new inflationary regime, which hasn't existed for 40 years. That's the number one, that's sort of the multi-trillion-dollar question for investors right now, because depending on what bonds do, we are either going to enter kind of another regime where bonds stay stable and risk assets catch a bid because, the economy's weakening and interest rates are coming down, so we expect monetary easing, or we're going to be in this new inflationary regime, which opens the door to just this mind-boggling Meltup.
Well, Jeff Gundlach might be giving some signals to that.
Yeah, that we're going to enter some kind of Meltup where basically currencies are going to be devalued really aggressively, and so capital is going to have to move out of cash into stocks and into precious metals because people are trying to maintain their purchasing power. And to me, kind of the scary thing is if we're really in an inflationary regime, very few people who manage money have any experience with that. The last time we had that really was the 70s. If you were a young analyst, young fund manager in the 70s, you're now in your 60s, 70s, you're probably retired. So there's really not a lot of executives or people in the capital markets who have experience in that environment, which opens the door to it being probably pretty catching a lot of people off guard.
Can you put some timeframes to what you were talking about with the dollar? You said in the short term and the intermediate term. Can you put some timeframes to that?
Yeah, the issue, the thing I'm kind of thinking is maybe we see it's the thing is from macroeconomics. So many people think of it as this kind of simple thing because you're looking at certain data points and then you have your model. But the reality is the data points are always different. What the labor market is saying right now is different than it said a year or two ago because we have different immigration policies. We have different labor force participation rates. The labor market now is nothing like it was in the 80s. And so you can't just simply look at data in a nominal term. You have to think, second and third tier thinking in terms of how these things break down. In the very near term, it's clear the economy's hot. It's clear that the Trump administration wants to run things hot. I'm simply talking about too many people are betting on the dollar dropping, and maybe the dollar's just going to bounce aggressively, maybe a 6 or 8 week move, or maybe it doesn't happen. Maybe the dollar just continues to break down. I'm just simply saying I don't want someone to see this interview and say, oh, this guy's bearish on the dollar. I need to just buy as aggressively as I can in precious metals, because it's quite possible that these things are very stretched. And it's possible that the next month we may see a pullback in risk assets.
Yeah, I appreciate that. And I also appreciate you talking about how it's a different time. In 2000 and 2008, central banks were not buying gold at historic levels like they are today.
That's a great point. Yeah.
In 2000 and 2008, debt to GDP levels were at much more respectable levels. They were 33% and 65% versus today it's over 120%.
Yes.
In 2008, oil prices were high, while today oil prices are low. In 2008, the precious metal and miners, they've been in a bull run for 6+ years, while today it's been maybe 18 months for gold and much less for silver and miners.
These are all excellent points. It's a different time. Yeah.
Yeah. So let me just run through this a little bit further here and then get to the question. In 2000 and 2008, the BRICS Plus consortium, they didn't exist. And they were not building alternative payment systems or creating pathways to net settle their trade in gold to get away from the dollar for a whole host of reasons. Versus today, that's exactly what they're doing. Right. Today, precious metals and miners bull market, it's vastly different than that of 2000 and 2008. And even the smaller runs in 2016 and 2020. For those reasons and more, do you expect this bull market in the precious metals and miners to behave differently than the previous ones did?
Absolutely. So I wrote a piece recently that gold was signaling a tectonic shift in the financial space. Tectonic means like game changing. You think of the tectonic plates. I chose that word very carefully because what gold did in 2024 really signaled something major, which was people typically, especially if in the United States, you're looking at gold denominated in dollars. But in 2024, gold broke out against the yen, it broke out against the franc, against the pound, it broke out against every major world currency. That's a major tell. It's one thing if gold's going up because the dollar's going down. It's another if gold's going up against every currency, regardless of that currency's strength. And gold just did another breakout about a couple of weeks ago, again against every major currency. These are major signals to us. And what it's signaling is that the financial system has realized that there's no path forward that doesn't involve money printing and doesn't involve spending, deficit spending. And what that means is the financial system is giving kind of a major, what you'd call tell, that it's time to move into hard assets. And we get a confirmation from this from the point you eloquently pointed out, which is central banks are buying gold. They're buying 1,000 tons a year. They've been doing that the last 4 years. And in fact, they currently sit on more gold than they do anything else, with the exception of the US dollar. They own more gold than treasuries at this point. So this is a major signal to us that even the guys and girls who can hit print and actually print currency at will are moving into hard assets out of paper assets. That to me is a major signal that we're entering a very different environment than anything we saw in 2008, 2000. This is an environment in which we're likely to see currency depreciation accelerate, And I suppose they're doing the playbook everyone's done through history, which is you try to inflate the debt away until inevitably you can't, and then you eventually default and there's some kind of crisis and you have to have a global reset.
Graham, is this why every Western bank on the street is openly advocating for gold now? I mean, it was unthinkable. Just a few months ago, gold was radioactive. It was a pet rock. It was a relic from the past. All of a sudden, the 2020 portfolio coming out of Morgan Stanley, getting rid of 20% bonds. What do you think is brewing here? Is it exactly?
I think they've read the writing on the wall. I mean, the reality is you have to remember with Wall Street, there's really astute operators who are actually managing capital and doing a good job. But then there's also just a lot of sales and marketing. And the sales and marketing side of things is you have to go where the money's made. That's why you see, for instance, a stock like Open Door Technology, which was at 50 cents a few months ago, goes up to $10. Suddenly Wall Street's upgrading it, saying it's great and fantastic. They should have been upgrading it at 50 cents before the massive run. Right. So the reality is these guys typically start moving into things and upgrading it when the move's already happened. So, I think the fact that gold's been on this just massive run, they have to start. What that tells me is their clients are asking about gold, and they've realized we need to start advocating this stuff because this is what the clients want. So we need to start suggesting this. Having said that, we're seeing large-scale financial institutions changing the asset allocation breakdown for things. That's very significant because what that means is that billions, maybe even trillions of dollars of capital that previously was not being told to buy precious metals is starting to be told to do that, because you have to remember the typical individual investor, we're just little canoes in the ocean. The big pension funds, the big hedge funds, those institutions, those are the oil tankers. And you saw this with, say, Bitcoin. When I saw BlackRock move into Bitcoin and launch its ETF, that was a major signal that the large-scale financial institutions are pushing for adoption of crypto. So the fact we're seeing Morgan Stanley and some of these other financial houses on Wall Street say it's time to own precious metals, that tells me we're really in a secular change. It's a time in which, regardless of whether or not it's the best thing to do, people are going to be urged to buy precious metals, which is a massive tailwind for that sector. There's so little capital put into precious metals globally. It could potentially go just to levels people can't imagine.
Yeah, and that urging that you're talking about makes you wonder if the powers that be are trying to push up the price for some event of some kind or something.
Possibly, yeah.
Right. All right. So Graham, it's becoming increasingly clear that the West's Achilles heel is critical minerals. The U.S. and the allies, they're waking up to this hard truth. Their tech and their military edge relies on minerals controlled by geopolitical rivals.
Right.
The response? It seems to be a government-backed mining boom, whatever the costs. Your thoughts?
Yeah, I agree with that completely. This, some things have changed in a major way for the second term of the Trump administration. Some things are the same. This is similar to what Trump started. Regardless of your personal feelings about Trump and regardless of your personal feelings about how he portrays the message, the fundamental message he was trying to make in 2016, aside from immigration, was that from a strategic, from a national security and strategic defensive position, it doesn't make sense that we no longer make things. It doesn't make sense that we rely on countries that aren't necessarily our allies to provide us with things we need in order to make antibiotics, to make mining equipment, to make things we need for our economy and people to stay healthy. And, obviously the message can get lost in the delivery, and a lot of people didn't see that. But that is continued in the second term with the Trump administration. In the first term, they used the National Defense Act to advocate for the development of certain sort of what they called vital assets that are vital to the national security. That kind of got swept under the rug because at the time everyone was talking about Russia, and all these impeachments and so on and so forth. But, they're doing that again this time, only this time they're saying, screw it, we're going to actually start buying companies outright with government money. So that's a major signal that they're taking this very seriously because they're realizing exactly what you pointed out. We need to have the ability to develop this stuff ourselves because it's a matter of national security, regardless of whether you like the Trump administration or not. That's simply what they're trying to do. I'm not saying it's necessarily, I'm a fan of them or not. That's just what they're trying to accomplish from a security perspective.
Just observation, right? So there's another observation. A few days ago, Trump was asked a question about uranium purchases from Russia. He had his Secretary of the Interior, Doug Burgum, there, and he said, Doug, would you answer the question? Mm-hmm. And Doug went ahead and answered the question. Of course, he was, saying that we're upset that we're buying this much and we're going to do everything we can to halt that. But what was notable, observable, was that he went on to say the mantra used to be drill, baby, drill in relation to oil. Yeah. He said the new mantra is mine, baby, mine.
Yeah.
I mean, the breadcrumbs seem to be piling up here.
That's it. You're really good at connecting dots in ways a lot of interviewers aren't. So my hat's off to you. That's a very astute observation. And this kind of brings us to the critical point where it kind of ties back to a point I made earlier, which is, being bearish on things. The U.S. government owns them. We own a money printer and they can print money at will to acquire things. And they've already acquired Intel. They've acquired Lithium of Americas. It's very clear that they're going to start acquiring things, most likely in the mining sector, because those are strategically vital assets, specifically to industrial base, specifically to manufacturing, and to the defense industries. So to me, that's a major tailwind, because how do you, regardless of how bearish you are, how are you going to compete with Uncle Sam taking stakes in some of these companies? And it's clear they're not stopping. They're probably going to get even more aggressive with it.
Yeah. Okay, so Graham, there's about $7 to $8 trillion sitting in money markets, collecting 4 to 5% interest. They're enjoying relative risk-free return. Yes. However, as the Fed continues to lower interest rates, some of that money is going to begin to move off the sidelines, seeking better returns. It's going to trickle at first, but the lower the rates become, the lower the returns they're enjoying. And, they went from 0 to 1%, and all of a sudden they were, some people were getting 50,000, 100,000 a year in risk-free, and their lives changed. They were giving it to their family, their kids, their grandkids, but that money could dry up and they're going to start seeking better returns for that money that's sitting idle on the sidelines. Do you expect some of that money to rotate into the precious metals at this point as we move forward, and the related equities? And if so, what kind of impact can that kind of money, and I'm not saying the full 7 to 8 trillion, but what kind of impact can that money that would rotate out of there have on this tiny sector?
Yeah, so that's actually, I put out a couple pieces to clients a few weeks ago saying I think there's a case for a great global Meltup. And a great global Meltup is going to include stocks as well as precious metals and precious metals miners. Stocks are fundamentally an inflation hedge initially, until inflation gets to the point that it eats into operating costs and profits fall. But, everyone's aware of stocks as an asset class. We're in a totally new regime where even Wall Street is advocating precious metals miners. And so little money is in that space. I was talking to Lawrence Leopard, fund manager, the other day. He told me the market cap of every miner in the United States is only $600 billion. It's less than $1 trillion. Bitcoin alone's a $1.3 trillion asset class. So that should give you an idea of how underappreciated, undervalued, and underallocated miners are. Now, so the idea is obviously, and you put it very well, we don't expect $7 or $8 trillion dollars to go into mining, but you only need, 10% of that $600 billion, and you've doubled the market cap of the entire sector. So, there is the potential that we really see some massive runs. Again, this brings me back to the 70s. In the 70s, the 70s might be a good proxy for some people to understand what happened. In the 70s, we had an inflationary recession in the first half of the decade. The Fed raised rates aggressively. They thought they'd tamed inflation. They started to cut rates again. During that first half of the decade, there was a bear market in equities that bottomed when the Fed stopped cutting, just like in 2022. And equities ripped higher as inflation came back into the financial system. But it was the second half of the decade when the miners really went parabolic, because at that point, the Fed finally got religion on inflation and realized raising rates doesn't necessarily end inflation. You have to also drain reserves. You have to get the money out of the financial system, which is what Volcker did, which politically was suicidal, but it actually accomplished getting inflation away. This is very similar to what the Fed's doing now. They raised rates aggressively. We had a bear market in stocks in 2022. They now paused, then they started easing. Stocks are in this major melt up. And inflation to me is clearly bottoming to a degree. There's no way the official inflation data points are correct. And even if they are, if you dig beneath the surface, I was reading, I think in July, the CPI, there's 88 components in the CPI. Over 2/3 of them are now appreciating at an annualized rate of over 3%. So regardless of what the headline of CPI is saying, the actual components, the underlying data is starting to turn back up again in a broadly based way. So I think there's a decent chance, and I think it's underappreciated, that we're entering a new inflationary regime where inflation is just at a higher level than it has been historically. I'm not saying necessarily double digits or even 8 or 9%, but what if inflation, the official data, stays around 3 or 4% and just stays there from now on? What if that becomes the new target for the Fed? That changes the entire asset allocation model for trillions of dollars of capital, which opens the door to price moves in the minors that would just be, life changing for some people.
Exactly. And, I think there's a few things to look at to support what you're talking about. The natural resource war that has been underway for the last few years, that is not deflationary. Yeah. What's happening with China, where their middle class, their business class is getting wealthier and wealthier. That's not deflationary. And when you consider the level of debt and debt servicing that the United States has to deal with, not just today, but what's coming in the future, that's not deflationary.
No.
So how could maybe AI is going to be a deflationary force, but it still feels like we're far enough. We don't even have a grid build out yet to get us to the point where we don't know if we're going to have bottlenecks. We're going to still see price increases coming before deflation really kicks in here.
That's an excellent point, and it brings me back to what I was saying about macro before. When you're a macro thinker, you need to be looking at, say, 4 or 5 things at the same time. And each change for one of them will have an impact on the others. And so far, we've been talking about, debt, inflation, deficit spending, the economy, those sorts of things. AI is a completely different piece that has a very unique dynamic. And again, we're at a kind of crossroads. We're about, AI sort of went public, quote unquote, November of 2022, was it? I think, or 23, when ChatGPT was launched. So I think it was 2022. So we're about 3 years into this thing. And so far, it's been a major capital expenditure boom. The big tech companies spent about $400 billion building out their infrastructure. And now we're starting to get really silly, where you see like NVIDIA investing in OpenAI, which is, a client of Oracle, which is also a customer of NVIDIA. So you're getting these weird circular kind of deals where it almost looks like they're paying their customers to buy their own things. So that's frothy. It's very clear we're very clearly in something of a bubble in AI, but the real question is, how far does the bubble go? Which brings me back to that point I made earlier that, things can get really, really silly. Everyone thought 1996 was silly, as you said before we started recording, and then it got just ludicrous for 4 more years. And I think it's possible that might happen with AI, but you're starting to get weird mixed signals. On the one hand, you've got guys like Mark Zuckerberg and the CEO of Microsoft and others saying, we're seeing these massive improvements in productivity. We've saved all this money. But then MIT comes out with a study that says 95% of companies that have implemented AI systems have actually yet to see any real pickup in revenues or cash flow. So, it's kind of I would say you're starting to see some red flags for the AI story. Maybe this thing isn't going to be this game changer that just leads to tens of thousands, millions of people losing their jobs, and we live in some weird new future where everything's robots and we're on universal income because no one needs to work. That's, as Elon Musk is saying. Maybe that's not the case, but what is clear is that the big tech companies are spending this money on the build out. The United States, as you pointed out very cleverly, has a kind of national security need to do this as well, because we're competing with China in this critical technological development. Those are major tailwinds. And so AI, regardless of what inning we're in, it's very clear we're not in the 9th. It's very clear it's not about to end. And it's very clear that the most powerful entity in the world, the United States government, wants this thing to work out. So, that's probably going to be Meltup related. I mean, you see some of the valuations of these plays like Palantir, CoreWeave, things like that. It's ridiculous, but things can get, way more ridiculous before the thing bursts.
Yeah.
Yeah.
Okay. So, Graham, investors own gold to protect their purchasing power and their
Yes.
wealth. It's a monetary metal. Silver is also a monetary metal, but most have forgotten that. I haven't forgotten that,
Yeah, of
but
course.
most people have. Silver is much more volatile. It is also an industrial metal.
Mm-hmm.
We have a generation of investors now that we have not seen before. These investors who chase risk and volatility, crypto, NFTs, AMC, and others are perfect examples. We have a cohort, a pretty large cohort that chase risk and volatility.
Mm-hmm.
As the rotation into precious metals accelerates, do you expect the action in silver to get more volatile and crazy than previous bull markets because of this extra layer of investors who chase risk and volatility?
Again, this brings back to that point we've been talking about. We're in a different regime. 60% of options volume now is these 0 day to expiration options plays, these options that expire the day of. That should give you an idea of how aggressively frothy retail investors have gotten in the market. And retail investors are much more pro-risk than large financial institutions, which is why you get these, just crazy moves in unprofitable companies. You get these things like Open Door going from 50 cents to $10 in the span of 8 weeks. The reality is a lot of these guys like to argue that they're tech or crypto gurus, but the reality is they just love volatility. They love big price movements. And now that we're starting to see some big price movements in the precious metals mining space, I very much think that they're going to start moving into that. And you're going to start seeing, on social media, people sort of circling the wagons and ramping some of this stuff higher. A lot of the crypto guys, they act almost like it's religion, but I really think they just love the volatility. And I think they're going to move into the precious metals mining space too. And
I'm not sure that many people understand how tiny the silver mining space is.
It's miniature. Guys like you and I talk about this stuff. You go and ask the average person on the street, what is the price of silver now? They have no clue. You have to remember, if you're someone who watches the financial markets closely and you like to talk about silver, you like to talk about gold, you're probably, I don't know, maybe 3% of the public. The average person doesn't have a clue what gold or silver is doing, and the fact that, they don't even start thinking about it till it's already moved hundreds of percent. So I think if, combining some of these things we're talking about, Wall Street's advocating, allocating to this space, the space is very minuscule. Silver is also an industrial metal that's critical for AI infrastructure build out. The Trump administration's in this kind of existential challenge to beat China in developing AI infrastructure. All of this adds up to silver doing very well.
And there's one more piece to that particular puzzle, and that's defense. From what I understand, because of the way the battlefield is changing, it's no longer these massive super tankers, but things have gotten real small and in bunches with AI driven. They're very smart and they're autonomous. And so the battlefield of the future requires a completely different set of weaponry and whatnot. So essentially what I'm saying is there is a new defense cycle getting ready to kick off. I think that's partly why Trump told NATO countries, you're on your own, and they're starting their own cycle.
Yeah, that's
because we're not going to carry them. We got to put it into our own defense cycle. Well, that cycle that's going to ramp up. It requires an immense amount of silver.
Yeah, that's exactly right. I think the way I would look at it is a major theme for the markets is tech. Most of the profit growth from the last 10 years has come from the tech space, which has led to this situation we're in now, where, tech is the largest sector by weight in the S&P 500. It's about a third of the market. The top 10 companies in the S&P 500, 8 of them are tech plays. They account for 25% of the market's weight. To give you an idea of how significant that is, if you combine the second and the third heaviest weighted sectors, I think it's finance and healthcare, it's still smaller than tech, and tech really has become this sort of national defense issue in terms of AI, in terms of developing drones, in terms of developing autonomous, weaponry and things like that. This is really, we're in a very tech-centric world, but tech is increasingly going to require critical minerals, of which silver is going to be one of them. Yeah. And so in many ways, you're going to get into this kind of two-pronged investment approach where you get the cash flows and profits from tech, but you also want to have some exposure to precious metals miners, because those are the guys producing the assets that are A, likely to be bought by the government, the Trump administration, but B, going to be necessary for the development of the tech.
And what happens if sovereigns or large companies like Tesla or a defense contractor starts to see what's happening in the silver market as retail, starts piling in, and they're like, no, we're going to corner. We need our supply.
Yep. And we already saw that with Tesla, didn't we? Yeah, exactly right. I think, was it lithium? It was a year or two ago, but Elon Musk was saying we're going to start trying to build our own lithium stash or something like that. So yeah, I agree with you there. It's a small space that a lot of dollars are going to be competing for, I should say.
Yeah. Well, this has been an incredible discussion. I want to welcome everyone who's tuning in to this fantastic interview with Graham Summers, Chief Market Strategist with Phoenix Capital Research. Before we wrap up here with our final set of questions for Graham, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report. I'm also positive you've been enjoying the conversation Graham and I have been having. Please let him know. Hit the like and subscribe button and leave a comment below the video. Excuse me. Graham, let's finish off our discussion with the asset ranking lightning round. We talked about it earlier. I'm going to ask you to rank a few assets as a buy or sell. Give a 1 to 100 score, 100 being an extreme buy, 1 being an extreme sell. Then just give 1 or 2 sentences as to why you take the position. We'll try to roll through these as quickly as possible in the interest of time. Sure. All right. Right now, on a scale of 1 to 100, is gold a buy or a sell, and why?
75. Very bullish on it long term. Massive run. Now it's consolidating a little bit. Curious to see if we see a pullback. Maybe it's people are a little too aggressive right now and some of the hot money needs to come out. So short term, maybe consolidation, maybe a correction, but long term, very bullish.
1 to 100 gold miners.
75, 80, somewhere around there. Same story. What's remarkable to me is the way the dip's being bought. Thought we'd get a larger dip based on what I thought was going to happen the last few days. Some of these plays, they're already back up 14, 10% today alone. They're not at their all-time highs again, but that dip's being aggressively bought. So very aggressive, very bullish. Short term, not certain, but 2-3 weeks out from now, very bullish.
It's possible that as retail gets nervous over the extended RSI, they're selling, and the portfolio managers are seeing that, and they're coming in and buying those dips.
Very much. I always try to talk in terms of time frames because I'm a trader, but I also have long term. I have short term clients, long term clients, and so I always try to talk. This is the framework I'm thinking. So short term, question mark. Long term, very bullish.
All right, 1 to 100 silver.
Wow,
even more physical silver.
Yeah, even more so than gold. Probably 85. But again, short term question mark. But silver's got some catching up to do. Gold's caught everyone's attention. Silver's very much underappreciated, specifically relative to tech. So a lot of upside, I think.
All right, silver miners, 1 to 100.
Same, 85, 80. Yeah.
All right, copper.
Ooh, tough one. Probably 60. Not as bullish on copper. It's very closely tied to economic growth, but I don't see the tailwinds of government. You see some tailwinds from the Trump administration maybe getting involved, but I don't think it's going to get the same sort of attention from the retail masses as gold and silver.
Okay. Physical metal, uranium.
very bullish, 85, 90. I don't see a future in which nuclear doesn't become a more significant play and as an energy perspective. And you specifically are seeing AI getting really aggressive about building nuclear generators. So very bullish uranium.
All right. Uranium miners.
Even more so. Even more so.
Okay. Oil.
Would have to pass on that. Can't. Oil's a tricky beast. I think the Trump administration really doesn't want oil to go up, and I wouldn't want to bet against what they're capable of accomplishing.
Yeah, I kind of agree with you, and I think that helps uranium at this moment. Yeah. The NASDAQ.
Short term, I think we have a pullback. Long term, I am very bullish stocks. I called for 7,000 on the S&P 500 back when it was trading around 5,500. And I actually think we could go to even 7,500 on the S&P 500 by next June. I think if we really get into a melt up and things really get silly, this thing could really go to places people can't imagine right now.
So give me a number for both NASDAQ and the S&P.
NASDAQ, I don't look at as closely. I tend to focus on S&P, so I wouldn't want to get too much in. I mean, they're kind of the same thing because S&P is so tech-centric. But S&P 500, 7,000, 7,500, maybe even 8,000, depending on how silly things get.
What about 1 to 100 though?
Stocks long. I'm very much bullish. 80 to 90 for stocks. Okay. Intermediate term. I think we're in a melt up. Yeah.
Okay. Short-term treasuries.
Well, the Fed's cutting, so very bullish there. But I have a lot of questions about bonds. I'd maybe say 60.
Do you like it just for optionality?
Yeah. I'm not really. The biggest thing I'm trying to watch is the bond market in terms of what we discussed earlier. That, we had that long-term bear market in yields, broke out, which meant it was over, and now it's consolidating. I'm watching that like a hawk. I want to see which way they go because that's going to be the signal. Are we going deflation or inflation? I'm leaning towards inflation, but what I think doesn't matter. What matters is what the market thinks, and that's why I'm watching the bond market closely.
Yeah, I just struggle with, Gunlock manages how many tens of billions or more, and he's out there advocating for 25% gold. I mean, he's talking against his book. It's just hard to, get my head around that with that big of a number.
Yeah.
Know what I'm saying?
It says a lot, doesn't it? You wouldn't say something that's that antithetical to what you manage unless you're really seeing appetite from investors, would you?
Right, especially at the level he's at.
Yeah.
Okay. Agreed. Yeah. Long-term treasuries.
Very bearish. Yeah. I mean, the only bullish case I can possibly see is that if the Trump administration completely co-opts the Fed and then uses that to roll over as much debt as possible on the long term. But I don't see a world where there's less debt. I see a world where there's more debt, and I see a world where there's more money printing. So long term, not very bullish, no.
So what number would you give it?
Oh gosh, 20, 30 tops. Yeah.
All right. On a scale of 1 to 10, each representing a percentage, where do you see inflation ending the first quarter of 26?
Wow. I think it's highly likely we're around 3. I think, or higher. Yeah.
So that 3 to 4 range you mentioned earlier in the discussion.
I think we're going to be in a new regime. You can Fed officials are already sort of laying the foundation for changing their inflation target. If you read between the lines of some of the speeches we're seeing, I mean, what was her name? Logan just came out and said that the Fed needs to completely get away from the Fed funds rate to a completely different measure of how we sort of price money. I think they've realized the writing's on the wall, and they're laying the groundwork for a new kind of framework where inflation targets are higher, and they basically say, yeah, we'd rather risk higher inflation than a recession.
Yeah. All right. So 1 to 10 probability we're heading into a recession by the end of the first quarter of 26.
I think very unlikely. There's just when you're running deficits like we're running and you're easing at the same time, they want to run the economy hot, which means the only thing that's going to stop that is the bond market sort of breaking them due to inflationary pressures. So I don't see the economy rolling over. If you look at, I mean, heck, the consumer is 70% of GDP. Retail stocks, the retail ETF just hit new all-time highs. I mean, the Red Book Index, all of these things, there's always things you can point to that are negative. But if you look at what consumers are actually doing, they're spending a lot of money. So I don't really see any signs the economy's cracking. There are cracks in the labor market, but now the Fed's going to have to play catch up and ease aggressively to cushion that.
All right. Finally, the recommended portfolio allocation has always been 60-40 for a generation.
Yeah.
Now, Morgan Stanley comes out at 60-20-20, 20% gold. But, you go to any financial advisor, Edward Jones or whomever, and who's at this point is recommending gold. They're still not.
No.
What is your recommended allocation for gold, silver, precious metals related? What's a decent percentage that people should hold?
It's funny. I shifted my clients about 6 months ago to basically a 60-20-20. It was actually a little different. It was 60-25-15. 15 being precious metals, and we've been in that for 6 months. So I'm kind of laughing internally to see Wall Street sort of playing catch up with that model I've been using. That's where I'm at right now. I think precious metals are really exciting, but they're very volatile. So I'm nervous telling anybody to put too much capital to work there, because you got to have guts of steel to ride some of those things. I mean, some of these plays were down 15% in a single day the other day. Not many people can see that and just deal with it and be fine with it. So, bulk would be in stocks at least until inflation starts to cripple profits. But, definitely not bullish on bonds, and definitely liking precious metals more. Yeah.
Wonderful. Okay, Graham, would you please share a key takeaway that you want to leave with viewers for them to keep in mind about today's economic, market, monetary situation, or precious metals, anything, and then let everyone know where they could learn more about your work and how they can connect with you?
Sure. I'll do the second one first. So if you just Google Graham Summers MBA, I have my company, Phoenix Capital Research. We sell investment research reports for a number of different clients. We do short-term swing trading, do day trading with options, but we also do long-term buy and hold stock picking. So we've kind of got products that are designed for every risk appetite for investors. My books are on Amazon, The Everything Bubble, Into the Abyss. You can find me there. I also have a podcast, Bulls, Bears, and BS I do. So there's a number of different places you can get a hold of me or get access to my work. What was the first point again? The one you
just to leave viewers with. Yeah.
So a thing that I think we all need to remember, I think 2008 had a major effect on people that they start to expect really bad things. And the framework you need to think is stuff like the Great Financial Crisis or the COVID crash. That's like a once in 10-year thing. And there's always problems. It's kind of like your health. If you think about how complicated our physical bodies are, something could go off the rails at any given moment and you get incredibly sick. But the reality is the typical person, day after day after day, your life generally goes along pretty decently. The markets are similar to that. And for the most part, stocks tend to go up. That's not to say bad things can't happen, but you have to be very wary of a negative bias because you're betting against an asset class that historically almost always goes up. And when you've got an administration like the Trump administration that is so stock obsessed, I would be very hesitant to get too bearish. I would really let the market tell me when it's time to get out. And so I would be wary of doom and gloom. And instead I would think I need to ride this thing as long as I can and then get out of it when it's time and try to sidestep the bear market. But, really wait for the market to tell you. Don't try to time a top. If you want to time a top, even the greatest investors in the world don't get tops correct.
Outstanding. Graham, thanks for coming on to Metals and Miners, for being so generous with your time, analysis, and ideas. It's been a lot of fun to spend the time with you. I look forward to having you back on sometime soon. Everybody else, thanks for watching.
Thank you. It's a pleasure to be here.
Before we wrap up here with our final set of questions for Graham, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, If You Don't Own Gold, neither history nor economics. That's a famous quote by investing legend Ray Dalio. That's also the name of the report.